Good evening, everyone, and welcome to today's webinar. My name is Sara Waqar, and I have over 12 years of experience in the financial markets as a prop trader and as an educator. I hold a FINRA license from US, and I hold the investment advisor's license from CMA in UAE. And my expertise is around derivatives trading, currencies, commodities, and stock indices. Over the years, I have taught multiple individuals from a wide range of backgrounds and professions on how to develop effective trading strategies, sound risk management practices, and discipline required for long-term consistent performance in the financial markets. Welcome to Amana. Amana is a leading brokerage with a 15-year track record of providing clients with world-class trading experience through advanced technology, fast executions, and a dedicated customer support. We are regulated both locally and internationally, locally from DFSA and from CMA, previously known as SCA. And also internationally, we are regulated from SISEC in Europe, from CMA in Lebanon, from LFSA in Malaysia, and also from FSC in Mauritius. We have a very strong focus on the MENA region. So we provide access to both regional as well as international markets. Through our platform, you can trade more than 5,500 instruments, both leveraged and non-leveraged, which includes all asset classes such as stocks, currencies, commodities, indices, ETFs, and physical shares. So if you have any questions in today's session, we are happy to address them in the Q&A section below. So there is a chat section and a Q&A section. Please drop any questions you have in the Q&A section, and I will try my best to answer them during the webinar. And if you want to reach out to us, you can go to our website and chat with our live support. You can call us, you can email us through support@amana.app, or you can get in touch with your relationship manager. So today's topic is related to technical indicators and their limitations. So I am sure a lot of you guys who have traded see a lot of fancy indicators with different colors pasted on price charts, and some of you understand them and some of you don't understand them. But today we are going to go deeper into this topic of what are technical indicators and how they help us with our trading, how they help us predict the markets. So before I begin, please read this disclaimer. So first, let's find out what are indicators. So indicators are basically nothing more than mathematical calculations which are plotted directly onto a chart. Now, this is something which is apart from the price chart. So usually the price chart is a candlesticks that we look at mostly. So this is a price chart, right? So indicators are tools or mathematical calculations which are derived from these prices, and they actually help us analyze the prices in different ways. They don't predict the future, or they don't know where the market is going to go next. Instead, what they do is they analyze what has already happened, and they present this information in a way which is easier for traders to interpret. Now, I will just give you a quick example of indicators. So here on top, if you click on indicators, we have this whole list of indicators. Now, there are actually a lot of indicators, and I don't want you to get overwhelmed with them, because they are all derived from the prices. When you put a certain mathematical function on a price, you get a certain indicator. So you can actually even build your own indicator if you want to. So what I'm going to do in this presentation is I'm going to discuss the most common and popular indicators that people use to help predict the trend or the momentum in the trend, or maybe the volume or the direction. So if I just click on, let's say, moving average exponential, I will get this line. So this is basically an indicator that's helping me predict the trend. So like I mentioned to you, that indicators are not predictive, but they are helpful because they make it easier for us to interpret prices. Now, before I even go into this presentation, I want you to understand is that some people think indicators are they're just buying and selling signals, which they are not. So don't make this mistake of thinking that indicators are giving me buy and sell signals. They are not signals. They do not accurately forecast the market. In reality, it is the prices which come first, and these indicators, or this line, for example, is derived from the prices themselves. So, in a sense, indicators follow prices or indicators lag prices. For example, this line represents the 20-day moving average. So what it's doing is it is taking, let me go to the daily chart, which is actually a better representation of this moving average. So this is the S&P 500 daily chart, and this line is the exponential moving average. So this line is just showing me an average of the last few days of the closing prices of this market. Now, if it is showing the average of prices, it is actually basing itself on the price itself. This is why I mentioned to you that the price is more important than the indicator itself, because the indicator's input is the price. If we don't have the price, we cannot plot the indicator. This does not also mean that indicators are not useful. They can help you identify trends or measure momentum or understand volatility or highlight some areas which deserve close attention. But the key is that you use indicators just as confirmation tools. You don't use them as stand-alone decision makers, or you don't just blindly base your decision on an indicator. So professionals rarely rely on a single indicator. Instead, they look for different factors. They look for a clearly trending market. They look for prices bouncing to a particular support or resistance level. They look for confluence with the different indicators that they're using on this price level. They also look for price action. When they find everything, then they enter using a strict risk management technique with an exit strategy already planned before the trade. So these are all the different steps that you take. And I will now proceed, and I will first discuss the moving averages, the simple moving average and the exponential moving average. So, indicators can actually be divided into four types. So, there are indicators which help you identify the direction of the market, whether it is bullish or bearish. These are called trend indicators. So, examples of these would be moving averages and MACD, which we will just see in a while. Then there are momentum indicators. These indicators tell you the speed of the trend. So they tell you if the speed of the trend is accelerating or it is getting slower. And an example of such an indicator, which is very popular, is the relative strength index, or RSI. Then we have volatility indicators. So volatility indicators will just tell you how much the price is expanding or contracting around an average. They are not going to tell you about the direction of the trend or the momentum. Again, examples of such indicators are Bollinger bands, which a lot of people use, and the average true range as well. And then we have another thing, which is not strictly an indicator, but it is just a tool which helps us to draw certain support and resistance lines, which could trigger a price change. An example of that is Fibonacci retracement. So all of these are actually very, very popular and very well-known signals or indicators which are used by traders. So if we go to the simple moving average, so a simple moving average is basically, what it does is that it plots the average of the previous few days, like the previous 10 days or the previous 20 days, and the average is taken from the closing price. So if we go here, again, I am just going to work on the one chart, which is the S&P 500. So just to keep things simple, and let me delete this indicator first so I can work one by one with all indicators. I will delete it from here. I will go here on top and I will write moving average, which is a trend indicator. And I will select Actually, there are different types of moving averages. Wait, this is so moving. So this simple one is the simple moving average, which is just moving average here on the Amana platform. And other platforms, it could be SMA. So if I click on this, I get this particular line. And if I want to actually see what this line means, I will go to the settings. So here are the settings. And in the settings, the input says that it's the 9-day simple moving average. So I can actually change this to whatever, 15-day moving average or 20-day moving average or whatever. So people like to use different moving averages. For example, if I want to find out, the average trend for the past, let's say, 2 weeks, I could use the 14-day moving average as an example, which will be more smooth. So how do we work with this moving average? What does it actually mean? So what it means is simply that if the moving average is, if the price line is trending above the moving average, it is usually considered to be bullish. And if the prices are if the prices drop below the moving average, then it is considered to be a bearish trend. Similarly, we have another moving average, which is a different type, which is called the exponential moving average or the EMA. So if I write exponential, moving average exponential, again, you have a different line. If I click on this and I go to settings, I can actually give my own inputs. If I need a 21-day exponential moving average, I can do that. The style, I can also change the color from here. If I want this to become yellow, for more visibility, I can do that. So I can change the inputs as well according to what I want, right? So the difference between the simple moving average and the exponential moving average is that the exponential moving average gives more weight to the recent data in calculating the average. So it exponentially gives more weight. Let's suppose there are 14 days. So it will give more weight to the recent most day and then a bit less weight to the day before. And this is how it will calculate the average. So what it is doing is it is calculating the average, but giving more weight to recent prices. And people use both of these. And common settings for the simple moving average is the 50-day moving average, the 100-day, and the 200-day moving average. For exponential is the 9, 20, and the 50-day exponential moving average. So the simple moving average produces a smoother line, and the EMA is going to produce a a line which is closer to the price action because it is giving more weight to the recent most prices. Now, how do we interpret it? So I'm just going to give you a simple example. So actually the 50-day and the 200-day simple moving average is what's considered to be, important. So let's work with, let's look here first. So here I have the two lines on this price chart. One line is the 200-day simple moving average. The other is the 50-day simple moving average. When the 50-day crosses over to the 200-day, we consider that to be a major bullish signal thinking that macro fundamentals are becoming more bullish. And this is also called the golden cross. So the golden cross happens when the 50-day SMA is going to crosses above the 200 SMA, okay? And the death cross happens when the 50-day crosses below the 200-day. It is just the opposite. And that means that this is like the overall trend or direction is becoming bearish. So let's try and apply this to gold before we move on, because a lot of people they have different kind of opinions about gold right now. So let me pull out the chart. So this is the gold chart. I will get rid of these indicators first. And now what I will do is I'm going to plot the 50-day moving average so I'm going to I will go for the moving average double. And then I will just change the settings here, which is a quicker thing to do. So I will just go in the settings. I'll go in the inputs, and the first period I will put is 50. The second is 200, right? Let's see. Style is the first one. The 50-day is the orange one, and the 200 one is the blue one. Okay, right. So As we can see, so again, this is not an opinion of mine, or this is not a recommendation. This is just something that I am showing you so that you can analyze things better. So I'm on the gold chart. I have zoomed out and I'm on the daily time frame. Just please make note of one thing. When you are looking at the moving averages or other indicators, it is best to be on the daily time frame, because the daily time frame is going to take the averages of the closings of every day, which makes sense because that is what the average is supposed to be. If you, for example, plot these same lines on, let's say, a 15-minute chart, then how this line will be plotted is it will take the closing of the 15-minute intervals. So whatever you get there on the smaller time frame is not going to be actually predictive in a or helpful. It's just going to be marking the average based on the smaller intervals, which are just noise. So what we actually want to do is we want to be on the daily time frame so that the average is calculated from the closing prices of each day. So yeah, we can see that this is a cross. So the 50-day moving average is actually crossing below the 200 moving average. And what does this mean? So this is considered, according to this SMA, a major bearish signal. But like I said, there are a lot of limitations of these averages. For example, they are lagging in nature. So by the time a 50 to 200 cross is officially confirmed, the initial directional move is already well underway. So what it means is that if this chart is telling me that, so what is chart is actually telling me, according to this crossover of moving averages, this gold is now overall turning bearish. The macroeconomic fundamentals are suggestive of a bearish turn. However, we actually need a lot more information. We need to observe the long-term support and resistance levels as well. Just observe one thing. Gold sits at a previous support level. So this was a previous support level and we have the prices exactly at that level. So it is a possibility that gold holds on to this level and actually bounces up. It's just a possibility because it sits on a support level. If the support is broken downwards, then yes, we could see it plummet further. So again, I have something which is opposite of what this crossover is suggesting me. And then, yes, we need to pay a lot of attention to price action as well, which is the individual candlesticks. So if I start seeing very bullish candlesticks from here, then we could actually see gold go up. And we also have to keep an eye on the macroeconomic fundamentals, the bigger picture, the broader picture. So right now, most of the money is flowing out of gold because the conflict, the US-Iran conflict has cooled down a bit. Then we have this AI super cycle in the equities. So there's rotation into the equities and other things as well. And we have some kind of rate hike fears as well from the Fed, which means that people want to put money in, take out money from gold, which does not give a fixed return, and put it in a savings account, etc. So we have these pressures on gold right now at the moment, but I think that just a crossover is not something which should just make you jump into this trade and short gold. You need more confirmation. Like I said, look at this support. If the support is broken, that is a further confirmation that there is indeed a bearish trend in gold and gold might go down further. So yes, so confirmation of other things is important and confluence with other things is important. So let's move on. And similarly, we have another crossover which traders considered important, which is for the EMA, not the SM. So this is the simple moving average. This is the exponential moving average. So the crossover is between the 20 and the 50 EMA. If the 20 EMA crosses above the 50, that's momentum picking up in the shorter term, because again, these are shorter periods. 20 versus 50 is a shorter period as compared to a long-term period, which is 50 versus 100. And then bearish if the 20 EMA line crosses below the 50 EMA line. Okay. Again, identification of all this should be on the daily time frame. Now let's move on to MACD. Now, MACD is another type of indicator, and this is a momentum indicator. So the previous one were trend indicators, which gave you an idea about the overall direction. So the MACD is actually short for moving average convergence divergence. And it sounds scary, but it is not actually scary. It is a very simple interpretation of an indicator. So what is this? This is basically an indicator which is built from moving averages. So it just calculates the difference between two exponential moving averages and plots a line, which is the difference of these two moving averages. I believe, yeah, it's the 9 and the 12-day moving average. So the difference between those moving averages is plotted as a line, and that line is called the MACD line, which is this blue line that you see. There is another line here, which is called the signal line, which is the orange line. The signal line is basically the 9-day EMA of the blue line. So you don't have to get very confused with the technicalities of it, but focus more on what the crossing of these lines will say. So simply speaking, we will have two lines in this indicator. The first is the blue line called the MACD line. The second is the orange line called the signal line. So if the MACD line is considered to be above the signal line, so the blue line is above the orange line. What this means is that momentum is building up in the trend. There is increased momentum. And if this blue line falls below the orange line, this means that the momentum is fading in the trend, and the trend is becoming bearish. So this crossover of the lines is signifying that the bullish momentum is changing into a bearish momentum. And again, this white line is the zero line. So MACD above the zero line means that there's an overall bullish context, and below this white line is an overall bearish context. So MACD is the thing to understand is that a lot of people use this indicator again in confluence with other factors. So if I go back to the S&P, and if you just write here, let me get rid of these lines. So I have this appearing here, right? And I can make this bigger, or yeah. So it's best to read them alongside each other. The blue line being above the orange line signifies an increased momentum in the trend. And as you can see, we had a crossover here. So right now, what is happening right now in S&P is that the orange line has taken above the blue line, which means that the momentum is falling in the trend. So the trend is slowing down. And again, this is the zero line here. So if these two lines go below the zero line, that itself means the trend is becoming bearish. Again, the limitation of this indicator is it is a double lagging indicator. Why? Because it is derived from the moving averages. Moving averages themselves are lagging indicators. And if this is derived from them, this is a double lagging indicator. Okay. So, which means that signals arrive relatively late to the MACD. And in markets which are not trending, which are sideways, it can actually generate false crossover signals. So there is a limitation to using it. Then we move on to the relative strength index. This is another type of indicator. And this indicator is also, it measures the speed and magnitude of the recent price changes. And what it does is it simply has these three lines. So it has this line, which is the 70 line, it has a 30 line, and it has a middle line, which is the 50 line. Okay. So it actually compares the average gains of the last 14 days to the average losses of the last 14 days. And a reading above 70 actually means that the price is overbought. It is too high, so it will fall. So if the signal goes above 70, what this means is prices are too overstretched, they're overbought, and they can potentially fall. And similarly, if it dips below 30, it means the prices are oversold. So the prices can actually rise up from here. So, and if it is around 50, then it means, there is no overbought or oversold condition. The prices are just closer to the average. And if we are to plot this again on here, we will go here and write relative strength index. And here we have. So by the way, even if you're not using the Amana app, if you're using any other platform, you're going to find these indicators there. Or they are present on all the platforms. So I hope that you can see this clearly. If you can't, I will try and expand this. So this is the relative strength index. So this is the 70 line. This is the 30 line. Anything, if it stretches over the 70 line, it means prices will fall. And sorry, it does not mean prices will fall. This is how it is interpreted. So again, this is not something which is magical, or it should be just simply used as a signal that anytime you see it crossing over 70, you press the sell button, and anytime you see it dipping below 30, you just buy. It has to be used in confluence with everything else. You have to look at the trend, you have to look at simple support and resistance, you have to look at the price action as well. And you can use this alongside. So if everything aligns, for example, if you're here and this is also support, this and here you also find bullish price action and the RSI is also below 30, then yes, this is a good place where you can actually enter as a buyer. So now let's see what's actually happened in this case. So somebody's just asked me a question, is it recommended to use RSI on the daily time frame as well as the SMA? I would always recommend everybody to make the daily as the major frame of reference, especially when you're using anything, when you're using indicators, when you're using support and resistances, when you are looking at the long-term trend, or when you're doing anything. The only thing that you could go for in the smaller time frames is just fine-tuning your entries. The right kind of levels or the support and the resistances that you find on the daily are the real ones which tend to hold and which are actually filtering out all the smaller noise on the smaller time frames. So it is much safer. It is much more predictable to be on the higher time frames than the lower time frames. And in case of indicators, yes, I think that definitely you should use them on the daily. If you want to take a trade on a shorter time frame, again, you would at least know the levels on the daily and you would have those in your mind, and using those levels you could take entries on the shorter time frames. But you would be aware of the long-term support and resistances, or the long-term, the crossovers or the trends. And even if you take a trade on a shorter time frame, on a smaller time frame, it will, in this way, using a top to bottom approach, as in analyzing the higher time frames first and then coming down to the lower time frames to just fine tune your entries, this will actually lead to much more predictable results, because trends on the higher time frames obviously tend to last longer. They tend to last for months, weeks to months to even years. If I see here, we had the RSI fall below 30, and yes, this was actually, in this case, in the case of S&P, it worked quite well. Again, right now we had a lot of time period with the RSI above 70. But if you see here, this might not necessarily be a bearish signal, because in long-term trends, sometimes the RSI tends to just give false signals, and later on it will just adjust itself. So I have an uptrend, right? Here I had the RSI go over 70. So for a person with a simple approach, they would say the RSI is above 70, I need to sell. However, we can see that the trend is slowing down. It is slowing down definitely in S&P, but still intact. In fact, what I have is I have a dip and then I have another dip, but the second dip is smaller than the first dip. So I have a low which is higher than the previous low. So in fact, it is still a positive indication for me that we are still in a bullish market. So the momentum might be fading a bit, but sorry, oh God. So I just want to show you that, this slope here. So the momentum might be fading, but if I see, again, the prices are still looking bullish. So the idea is this indicator can be used in an uptrending market, for example, to look at the extent of a dip. So in an uptrending market, it's not usually a good idea to short. So what I would do is I would give more weight to the over sold conditions than the overbought conditions, because the oversold condition is telling me that the dip is over, that the downward dip might be over, like in this case. But I'm not paying a lot of attention to the overbought conditions because I know this market is overall an uptrending market. So what I'm doing is I am combining the market structure with the RSI. I'm not using the RSI in isolation or blindly. What I mean by the market structure is if I go on the weekly, this is a strictly uptrending market. So what I personally don't like to move against the trend. But what I would like to know is when this dip is going to be done so that I can buy the dip. So in this case, the RSI was good at signaling. And in this case, yes, in this particular case, it did not go below 30. So yes, they work sometimes and they don't work sometimes. So in this case, I did have this green candle, the price itself, which was the price action itself, which I give more weightage to as compared to the indicators. And if you're interested to learn more about price action, I've done previous webinars on this, and I think they have been uploaded on Amana's YouTube channel. So if you've missed them, you can go and watch them there. By the way, we are uploading all of these webinars on the channel. So if you've missed any, you can just go and watch those recorded sessions. So the next thing that I'm going to discuss is the Bollinger Bands, which are volatility indicators. So again, they're very widely used, and some of you may also have taken maths lessons or stats lessons on them. So Bollinger Bands will basically have one line in the middle, which is the 20 period simple moving average. And then there's a line on top and there's a line on bottom, which are two standard deviations away from the middle line. Okay. The idea is that this is a volatility indicator. So when the bands widen, there's more volatility, and when the bands narrow, there's less volatility. And how do we interpret it? One way of interpreting it is then when the prices touch the upper band or they go through the upper band, it means it's an overbought condition and prices will go and revert to the mean, they will fall. And if the prices fall below the lower band, it means this is an oversold condition and prices should revert to the mean. So they should again move upwards towards the mean or towards the middle. And if the band narrows at one place, for example, if you see this area, the band is narrowing, all three of the lines are coming close together. What this means is that the prices are coiling in one place and the bands are squeezing, and that's a period of low volatility, and that can often leads to a strong breakout in either direction, upwards or downwards. So when the bands squeeze together, people think that they expect a bigger move coming ahead. How do we draw these? We just, sorry. So you write Bollinger Bands, and they have these settings, which you can also change, by the way, but these are the default settings, which most people use. So again, prices dropping below the lower band would mean it's oversold and it would go back to the mean. And these two instances are examples. And then again, when the bands narrow, it means a big move is coming. In this case, that did happen. But again, like I said, this is just one of the indicators which is widely used, and it will work better if you combine it with confluence factors. For example, again, if this is an uptrend, and let's say the price has moved above the upper band here, I would probably not sell because this is an overall upward market structure. So I will not react to this. I will, even though the price action is present here. So I've got these engulfer candles here, which is again a bearish price action. Even that is telling me there will be downward move. But like I said, this is just my personal strategy. I will probably not trade against a strong trend. But somebody else can, and they're not wrong, and they would actually have made some money from this dip. But then again, everybody has their different strategies, and the whole point is you don't trade blindly using an indicator. The most important thing is to do your risk management. I have spoken about this in the past as well, and I will repeat this again, that the most important thing, which is actually 80% of your trading, is managing your risk. It's not looking at the charts. It's not trying to choose the best market. Look, it's not pasting indicators. It's not looking at price. It is to have a very clean risk management and to execute it properly. So before going into any trade, you need to know what is my dollar risk on the trade. You need to decide a stop loss, calculate the quantity according to your stop loss and the risk which you decided. That is the quantity which will go in your order. So in case if you get stopped out, you lose exactly what you planned. And that is much more important. So that is the first, that should be your first line of focus. And this comes after that. So again, of course, having good strategy will give you an edge over others. But if your risk management is poor, then you are not going to see any long-term results. So that is the first thing that needs to be focused and corrected. Which brings me to the last indicator, which we would be doing, which is the average true range. Now, the average true range is basically an indicator which is not telling you any direction or any momentum or anything. It's only telling you the volatility. It is non-directional, which means it doesn't give you any direction or predictions. What it is doing is it measures average candle range to provide a measure of volatility, how volatile the prices are on average, or you can say how much they move on average during the last 14 days. So the limitation of this indicator is that, again, it's a lagging indicator because it is based on prices. So it is actually calculating past volatility. A market can shift from a low range, average true range, to extreme volatility instantly because of an unexpected event. So this is why I stress on your risk management before everything else. But again, I believe this is a very useful indicator. And why? Because it can help you to set your stop losses correctly. And why am I saying that? So let's just paste the average true range here. So it's just simply a line here. And I hope you guys can see this clearly. So do you see this red line here? So how does this help you? So having an average true range of 209 right now. So right now, S&P 500 has an average true range of 209. If I go to gold and if I do the same, if I paste this, so gold has an average true range of 263 right now. Okay. So what does this mean? This basically means that, the average volatility in gold right now is about $263. And that is that helps you. It's suggestive of how big your stop loss should be. So ideally, your stop loss should be bigger than the average true range because that is just representing daily volatility, average daily volatility. So if my stop loss needs to be much bigger, not much bigger, at least a little bigger than this, because if it is smaller than this, I can actually be stopped out during the daily fluctuations. So in this case, for gold, what it is suggesting is that your stop loss should ideally be below 263 points. And a rising line indicates more volatility. It does not indicate whether the market is moving up or down. It just indicates more volatility. So again, this is useful if you're doing your stop loss calculations, and some people will use a multiple of 1.5 to 2 on this. So they will say, okay, let's double this. So it's double of 260 is around 500. So we will put a stop loss of 500 or maybe multiply this by 1.5, if not 2. So, that's around what, something like 350 or 400. But the simple point to remember is it's always better if your stop loss is bigger than the average volatility. Because if it is not big, you can get stopped out easily. So I've discussed stop loss placements, and I always say that you need to put a stop loss below or above swing points. Stop losses should not be random. They should be put below a support if you're buying, or above a resistance if you're selling. But the ATR can just help you just check the size of your stop loss. And if you think if it is slightly above the ATR, then you're in the right direction. And if it is less than that, then probably your stop loss is too tight and there is danger of just being stopped out because of some normal volatility or market noise. And then the last thing that I want to do today is the Fibonacci's. Now, again, something that a lot of you must have heard. Fibonacci's are not, they are just a tool that help us look at support and resistances. So Fibonacci's are horizontal levels, like the way we draw support and resistances on the price charts. Fibonacci just suggests us certain support and resistance levels. And they are based on something called a Fibonacci number sequence and its mathematical ratios, which are some of the most important ratios are 50%, 38.2, and 61.8. Now, what does all of this mean? What this basically means is that when there is a certain move in the market, people expect the prices to retrace or to dip, right? Now, what the question is, what is the extent of that dip? How much they're going to dip? So, these ratios are popularly used to predict those dips. So after a certain move, people believe that 38.2, they will be dip up to 38.2%, or it can be somewhere around that. It definitely will not be that exact, but it will be something like 30 to 40%, or it could be 50%, which is a more of a psychological level, or it could be about 61.8 or 62%, which is a deeper pullback. So let's say prices have moved up. Either they will come down to this line, which is 38% retracement, or they will come down by 50%, which is this white line, or they will come down to 61.8%, which is again these pink lines. So how do we apply them? Again, they are better applied on a trend where you expect a pullback. So this is S&P, and I'm giving you the example because it has a very good overall uptrend. And if I have to apply this, again, what we do is we draw the Fibonacci from a high to a low. And the problem with the Fibonacci is that your high and low can be different from my high and low. You could be working on a different time frame. I could be working on a different time frame. Or the level of your high could be different from mine, and what you are thinking is a low, I could be thinking some other point as the low. So it is very arbitrary again. But because it is so popular, I wanted to also cover that. So what I'm doing is I've just selected the Fibonacci retracement from here, and I will just go to the top, and I can drag this down. So I'm going to the top and I'm dragging this down to the bottom, which is this point. So I took this point as the top, just as an example, and this point as the bottom. And then you see all these lines have appeared, and I'm going to make them bigger just to expand them so you can see them properly. I'll get rid of this indicator. Yeah, I think now you can see this more clearly. So again, someone had a question. Please, can you write your question in the Q&A section? So what I did was I considered this to be a high and this to be a low. Again, this is arbitrary. Someone can consider, a different high or a different low. But I'm just giving an example right now. And this is what it looks like on the daily, on the weekly. So let me just make, okay. So I want to know if the prices will dip down, and if they do dip down from these high levels, what will be the extent of that dip? So from this point, the prices could dip down to, like 78% of this whole move, which is the same as the 38 level. So which they have done already. So you can see that there's already been a dip. So this is one line which is showing that prices can dip to this line, the blue line, or they can dip to this line, or they can dip to this line, which is the 50%. So 50% means the 50% of this entire move. Or they can just come down to this line, which will actually mean that prices are turning bearish. So most people think that after this orange line, this level, prices could actually be, the trend could actually be turning around. So again, these are just some lines which are used as approximate support or resistance lines. And don't get too confused with them. Like I said, people have different methods of drawing this. So I personally don't use the Fibonacci's. I just use support and resistance directly from the price chart. But a lot of people also use them, and they are just simply used as approximate support or resistances where price can actually retrace before continuing. So yeah, again, price can come down to the blue line, which it did. And it has actually found support here. If you guys just see, price has actually bunched around this blue support line. So if it falls down further, it can go to this line, the 61.8 line. It can go till here. If it falls further, it can go to this line. So this is how the Fibonacci's are used, but they have limitations. I've given you an example of an uptrend where you can see the potential retracement zones. Again, there could be a shallow pullback, there could be a deep pullback, or there could be a deeper pullback, or and so on. And they sometimes don't work, to be honest. So actually, a large number of traders and algorithms and institutions are just working around these particular levels called Fibonacci levels. So sometimes they are self-fulfilling in that way. But honestly speaking, it is not reliable by itself, and you need to, if you are using Fibonacci, if you decide to use it, it has to be used strictly in confluence with other factors. Again, you have to remember the drawing of this is pretty, it could be different on your chart, and it could be different the way that you think, or I think, the way that what you consider to be a high or a low could be different. So two traders who are drawing this on the same chart can actually use different highs and lows, and they will produce entirely different levels. So there's no universal rule for this. There's no universal rule for which swing to use, which high to use, which low to use. And without confluence with other factors, it's unreliable. So now I want to just conclude the session and make some very important points. One problem is with stacking indicators. What that means is that people tend to use too many indicators together on the price chart. So they will tend to paste others. So it could be this, it could be this, it could be, this. So I have so many different indicators, and this is called indicator stacking, and it is not really a good idea, because they, in the end, are measuring exactly the same thing. They're derived from the prices themselves. So that is going to just create more complication, a messy price chart, and that's not really sometimes doing less is better than doing more. So their indicators are just confirmation tools. They are not signal generators. That's very important to remember. Give more importance to the price and to the price action. So more importance is to be given first to the risk management, then to the market structure, support and resistance levels drawn on higher time frames, and price action on or around those support or resistance levels. You can definitely use one or two or three of these indicators. For example, I sometimes use the 21-day exponential moving average. But why would I use that? I use that in a strong trend, and just I use it as a dynamic support. So just to give you an example, what I do is, in a strong trending market like the NASDAQ, getting rid of all these. This is the NASDAQ 100, very similar to S&P. So this is a nice uptrend. So in strong uptrends, what I could use the exponential moving average, the 21-day, which is about 3 weeks. Sorry. So I'm changing this to 21 here for the 21-day. So how do I use it? I use it as a support line. Why would I use it as a support line? Because in fast trends, markets usually don't go back to the previous. So you cannot sometimes expect a fast running market to just dip to the previous high. So the previous high was this one. This is the previous high. Do you see this point here and this point here? If I just zoom this in, so these were the previous high, and we usually expect the market to bounce down to the previous high and then move up, right? But sometimes it's not going to pull back that much, but just a bit. So I use the exponential moving average over 3 weeks just as a support line. So if the price touches that or comes near to this line, I would consider that to be sufficient pullback and start looking for a bullish price action signal to enter in line with the trend. And this is just one way of doing it. Some people use maybe a smaller, for faster trends, they might be using a 14-day moving average, not a 21-day, and use it as a support line. But that is only in case of fast trends. So again, there are different ways of using these indicators, but they are not to be used blindly, and they're not to be used as signals. So what no indicator can do is predict the future. They model normal historical behavior. They don't account for fundamentals. So they don't have any knowledge of news or any fundamental, any geopolitical situation or anything. They would not have any news of that. They are just built on the price itself. If the price is incorporating a certain event, they will just kind of mirror that. They do not eliminate any false signals. Yes, they tend to generate false signals as well. Risk management is your only defense, and they do not replace context. So an oversold reading of an indicator in a bear market is completely different from an oversold reading in a bull market. They do not also replace your trading plans. So a signal without a clear stop loss and a risk is, again, it does not matter if it's the right signal or a wrong signal. If you do it repeatedly, if you have a behavior of ignoring risk management repeatedly, then you would not actually find any long-term consistent results. So again, these are just some of the tools that just help you and make chart reading easy for you. And the most effective use of indicators is just select one or two, just understand them deeply and just learn the specific conditions under which they might fail. And it's better to stick to few rather than many. They will just work good as confirmation tools, not as primary signal generators. So the strongest trading decision is going to come from directly from the prices, from the market structure, and the indicators can then just confirm what you are thinking, and they will not be there to generate ideas for you independently. So don't look at them as independent signal generators. Okay. So this is it. I think our time is up, and thank you. I hope that you found this webinar to be informative and practical, and you have a clearer understanding of how to use these indicators in a more effective and in a realistic way. And I wish you all the very best in your trading journey, and I look forward to seeing you again on Tuesday. Thank you.